Hello, good morning. My name is Guillaume Lamé. I'm head of European research at Invesco. So very briefly, Invesco Real Estate in Europe, this is 10 billion euros AUM, a bit more than 1 billion in France, offices, retail, logistics, and hotel. So the research team at Invesco, this is a team of 5, 2 based in London, in Munich, and myself in Paris. We're covering 200 markets, cities, and sectors combined. And every 6 months, we produce forecasts for the European outlook. So thank you, Richard. This is here today to present to you the latest views we have in Europe based on the first half of 2017. So Europe, this year we've been very positive. We are seeing sentiment indicators all moving up. And this chart is showing you the difference in GDP growth forecast that were produced a year ago in 2016 and the latest ones in 2017. And you can see that in most Western European countries, the GDP growth anticipations have been revised upward, with an exception being UK, and this is due to Brexit. What's making European property attractive? If we compare the property to other asset classes, here the bonds, and we look at the yield gap between the property yield and the bond rate, the 10-year sovereign bond rate, we see if you look at the triangles here, in most of the cities we're covering, in most sectors, the current yield gap is at very high levels, particularly when you compare to the historical average trend, which is shown here. Moving forward, our forecasts suggest that interest rates will be rising, but smoothly and gradually. We've heard announcements by the European Central Bank announcing there will be a normalization, but this will be gradual, and if needed, it will re-inject liquidity. So we are in a very smooth path and gradual upward shift. There is a positive correlation with property, and we expect in 5 years' time to see property yields rising, but moderately, and therefore the risk premium here will be moving down. What we're assuming is that investors will be accepting the reduction in risk premium because if interest rates are rising, then anticipations for growth are stronger. In the near term, though, we believe that yields are likely to remain under pressure. There is a lot of appetite. There is a lot of capital coming to Europe. The transaction investment volumes here in Europe for the first half of 2017 has recorded a small fall compared to a year ago. So remember, 2016 was a very good, strong year in terms of transaction volumes. This was mainly due to UK, the Brexit, but also France. Surprisingly, this first half of the year, we've seen the French elections. There was a lot of wait and see until the summer. But as of today, we can expect a total volume of transactions in France, which should be comparable to that of last year, which is roughly 30 billion euros. Two interesting things are here, the very strong appetite for Southern Europe, namely Italy and Spain, Milan, Madrid, and Barcelona. And the other thing is, if you look at the right-hand side here, the breakdown by sector, you would see there are more green, which is housing and hotels. So there's much more demand for outside the traditional mainstream sectors. So we believe yields will remain under pressure, where we will find performance growth. The first will come from the market, the rental growth. On the left-hand side, these are our forecasts of rental growth in nominal terms. And out of our 200 markets, these are the top performers, in excess of 2% per annum on average over the next 5 years. The Spanish cities, Madrid, Barcelona, office in blue, we continue and maintain our views that the Spanish cities will outperform. They are still in a very steady recovery pace. We're seeing very sound fundamentals in the occupier market. In green, you have the residential sector. In the markets we're covering, there is an undersupply situation. We're anticipating some very good rental growth projections. In red, this is the logistics. If we had the same chart a year ago, you would barely see any logistics market in Europe. We're seeing some very big structural change coming from the e-commerce in particular, and we're very positive about it. And in purple, this is the retail, and mainly on the left-hand side, the best performers are likely to be the high street. Now, more interestingly, there is no Paris market in nominal terms. But if you look at the real rental growth, and we take out the local inflation outlook out of the nominal rental growth terms, you can see that you still have the top performers being the Spanish cities, but also you have the Western Crescent, which is coming. And this is basically driven by stronger than average employment growth projections. So at Invesco, we're looking at the near-term drivers for growth, but also at the long-term drivers, one of it being the innovation and e-commerce. E-commerce, this is not the first time we're saying it. This is not the first time we're talking about the theme, but it is really the first year we're seeing actual evidence of rental growth, but also in terms of demand growth drivers. Here is the evolution of the retail sales online, which is quite impressive if you compare to the stationary, the in-store sales. But remember that in Europe, the average online retail sales account for 8 to 10% of the total retail sales. In UK, which is the biggest market in online, we're talking about 15%. So there is still some room for further growth. Looking at the sector, office, and the supply in particular, if we look at this cycle compared to the previous cycle, what we're seeing is that the new construction activity, the new development, is quite low. The dots in blue is the new pipeline expected to be delivered within the next 2 years as a proportion of the existing stock. Roughly, in majority, this is low and lower than before. And the more you're moving to the right, the more you're seeing a supply risk. Dublin and Warsaw being the two evidenced by an acceleration in new supply, in new construction activity. Now, though, we had fears about that new supply coming through, but this year we've seen that there was a much bigger absorption and greater of this new space in those two cities. Nevertheless, we will remain careful when looking at anything here. But also, interestingly, the Parisian cities. If you look at the histogram, which is showing you the current vacancy rate, is very low relative to other European cities. Demand growth. One of the key metrics we're looking at is employment growth. If we compare the employment growth that was recorded over the last 5 years here, and you have the new forecast moving forward over the next 5 years, you'll see that demand growth is slowing. It's still progressing, but at a lower pace. This is certainly coming from different impacts from demographic changes, automation, and we need to be careful when we look at the office sector. Now, another way to drive performance up is also being asset managers. We need to bear in mind that there is additional cost for the tenant. So not only we're talking about the headline rent, but also service charges, local taxes. In Europe, the headline rent across most European cities account for 80% of the total occupancy cost for an occupier. There are 20% that are made of service charges and local taxes, and Paris is amongst the most expensive. And that's partly explaining our projections of moderate rent growth. Headline. Now, what does matter as well for us, landlord, is what we receive in net and what are the incentives being granted to the tenant. Paris, again, is standing at quite high levels. Incentives are moving down, but they're not back to where they were before the crisis, like in Stockholm or German cities. Now, because we do have projection that vacancy is falling, fundamentals are improving, we do expect a stronger reduction in incentives, and therefore for us, a stronger NOI growth than headline rent growth. So this is really about actively asset managing. Now, looking at cities, So this is a worldwide ranking for this millennial new generation, where we do have the work, live, and play. This is a ranking based on 4 factors. The first one is being the essentials. This is about metro access, convenience stores. Recreation, which is leisure part, any bars, restaurants, cinemas. Equality is about the parity between male and female, better integration, better tolerance. And the business ecosystem is a sufficient proportion of commercial real estate space in the location with green space. And you will see there are very few that are not European, so we're just making a very strong case for Europe today, making the cities attractive, but also French cities are amongst the top ranked. This is not only good for the commercial real estate, but really for any housing, hotel sectors. So to conclude, what are our strategic considerations? So we're not talking only about the near-term drivers, but also anything which is structural, which is a secular theme that we're seeing that might have an impact on the property market. We're very positive at Invesco about the residential. We're doing build-to-rent strategy in most of the UK, German cities, build-to-sell in Spain. We're also seeing interesting in Madrid, in the central location, there is an increasing trend to see those new generation looking to lease instead of owning in those central locations, though there is a big opportunity for us and hotels. Hotels will be focusing on the 7-day trading cities to benefit from both demand drivers from the business sectors, but also leisure, tourism. And this will be in cities such as Dublin, Amsterdam, and Barcelona. To cope with the structural change coming from IT and innovation, we need to make sure we have a sustainable investment, sustainable buildings over time to meet the new requirements coming from the occupier market. We will build, renovate, reposition in core locations. We will undertake logistics new development to meet the new requirements today in most of the central cities in Europe. One thing we also care about is the political risk, because it can be risk from one hand, but it can also be an opportunity for us. Brexit is a clear example of it. You've seen the recent choice made by the European Banking Agency, who chose Paris, which is a good start, which is a good sign for Paris. And we're not saying that because of this, the cities Frankfurt, Paris, Dublin will eventually benefit from it, but there is potential for it. And of course, to deliver the performance, granularity, local expertise, to have a local platform to deliver the performance. With these all themes going, the placemaking, we would undertake mixed-use schemes in order to provide the work, live, and play environment. We would be focusing on infrastructure new development, potentially new metro access coming that could provide enhanced values in a certain district. We're certainly doing it in Milan. And what we're not trying to do is chasing yields. So location is key for us, but if there is any potential to make it sustainable over time, that will be it. And that's really actively asset managing.